Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. You can feel the fear dripping off the bears right now. They are scrolling the Bitcoin chart after yesterday. They are seeing a red candle, and they are declaring Bitcoin dead for the 900th time. But my dearest little goblins, that panic is nothing but ignorance wearing a suit, because these people do not grasp the tidal math that I am about to unleash on them. I have numbers that are going to break their narrative, okay? I could not be more bullish on Bitcoin. The global net worth, $600 trillion. Global credit, $251 trillion. Roughly 42% of all wealth is represented in credit. And fun fact, every single dollar of that credit literally needs collateral to exist. And we all know that the fiat collateral is leaking trust day by day by day. And Bitcoin is the only asset that cannot be printed, seized, or politically diluted. And the moments that the markets understand this, a slice of that $251 trillion is going to flow into 21 million coins. So do the division in your head. It is incendiary. So when you hear all of these gloom merchants on Twitter just crying, volatility, risky, tulips, just remember that they are clinging to a system whose bedrock is IOUs stacked on top of other IOUs. And we all know that we are holding an instrument that is audited every 10 minutes by a global network that literally never sleeps. So to me right now, the choice is very simple. Either decaying collateral or digital capital that is carved in cryptographic stone. And today I'm going to prove why this $251 trillion credit stack is going to hunt for pristine capital. I'm going to expose all the cracks in the fiat system. I'm going to dissect the strategy playbook, and I'm going to show you the collateral flywheel that makes seven-figure Bitcoin a small baseline and not a moonshot. By the end of this video, you're going to start to question how fast you're going to move, because the longer that you hesitate, the more expensive each sat is going to become. I am turning panic into prophecy. Before we continue, please like and subscribe to the channel, because I bring the daily Bitcoin gospel to the masses. And also, I gotta thank Horizon for sponsoring this video, because Horizon lets you tap your rotting, drywall, disgusting home equity to put it into Bitcoin. That's right, home equity into Bitcoin with no debt, monthly payments, or term limits. The Bitcoin is fully yours to hold however you want, wherever you want. I'll talk more about them at the end of the video, but go to Horizon in the link in the description below. Now it's time for a bit of a lesson for you folks. The Dave Ramsey brainwashed folks toss around the word credit like it's some mysterious dark art, yet they swipe their Visa for a latte without a second thought. So now it's time to rip the veil off right here. Credit, folks, listen to this. Credit is simply borrowed future productivity, but priced today. That's correct. Credit is borrowed productivity that is priced today. Do you understand this yet? A lender front loads you purchasing power and you repay later with interest, and everybody wins if the trust holds. There is no black magic here. It is just math and confidence. But here's how the machine really works. A bank taps a keyboard, the loan appears, and voila, a brand new money deposit materializes. Now, loans create deposits, deposits spawn spending, and then spending fuels something called the GDP, the gross domestic product. And if you're not aware, credit is the oxygen of modern economies, literally the oxygen, but oxygen only matters if the tanks are not full of leaks. Are you starting to follow me? And that is where collateral enters, the lender's insurance policy. So if the borrower of the money flakes, the collateral gets liquidated. In the fiat system, the collateral is usually government bonds or real estate, which are assets that are rotting under inflation or suffering rate whiplash. So what Bitcoin is shining a light on for everybody is this supposed risk-free bedrock. It now looks like it's a termite-ridden beam. Credit itself also smooths the human roller coaster. What do I mean? Well, households, they borrow in bad months and then they repay in the good months. Companies, they issue bonds to build factories before profits exist, and savers earn yield instead of hoarding cash under a mattress. And all of that rides on one tidy assumption that the collateral will be worth something tomorrow. So when that assumption person dies, so does the entire party. And this is why Bitcoin is the new monetary substrate of the entire world, because of its fixed supply, the immediate auditability, the global liquidity, the zero counterparty risk. If you plug in Bitcoin as collateral, the entire credit stack regains that structural integrity that is currently missing. Just picture lending markets where a 15-second blockchain confirmation replaces a 3-day settlement queue. Imagine interest rates that are set by math instead of a central bank press conference. This is not science fiction. The rails already exist right now on Lightning and side chains. They are just waiting for the institutions to wake up. So remember, credit itself is not evil, despite what all of your Dave Ramsey traditional finance brainwashing has told you. Credit is simply leverage on trust, and today I am going to demolish the myth that Bitcoin cannot handle that trust load. So stick around. Next, I am going to dissect why fiat collateral is bleeding credibility faster than a bankrupt meme stock. And I'm going to show you how Bitcoin plugs that leak and then supercharges the lending engine. So strap in, the bear tears are going to be quite plentiful. Let us zoom out and take the planetary balance sheet in one breath here. There are $600 trillion of global net worth on paper, and $251 trillion of that is debt. In plain English, 4 out of every $10 that you call wealth is actually someone else's IOU. So fine, leverage is normal, but only if the collateral is bulletproof. Now remember, when we peek behind the curtain of what is backing that leverage in the system right now, there are sovereign bonds that governments continue to refinance with fresh deficits, real estate that is totally propped up by zero rate fantasies, corporate paper rated investment grade by the same agencies that missed the 2008 financial crisis. And so all of these assets, they wobble every single time inflation flinches or a central bank clears its throat. This pie chart of the global wealth versus credit, it is simply a ticking clock. Roughly 42% of all the global wealth depends on collateral that you would not accept for a bicycle off of Craigslist. And this is why the fear is suddenly palpable, because investors know the math. They just pretend the termites in the beam are decorative. And Bitcoin sits outside of that entire legacy casino, but nothing can stop it from intruding. Because it is a bearer asset that is audited by code, it's totally untouchable by any political whim from any country, and it's trading every single minute of every day. So when the crowd finally admits that their risk-free bonds are one rate hike away from a markdown, the collateral migration will look very instant in hindsight. And remember the rule of capital gravity. Capital flees the weak horse and backs the strong one. So when it comes to us Bitcoiners, fear is not our enemy, literally just ignorance is, and I am erasing that right now. So thank you for listening. You are part of the Orange Army. You guys got to remember that the US Treasuries that were once the gold standard, they suffered a deeper drawdown in 2022 to 2023 than any equity bear market since the Great Depression. The Italian 10-year bonds trade like meme stocks whenever the European central bank sneezes. And real estate is a leveraged carry trade that is chained to mortgage rates that can double in 12 months. And the corporate bonds that are rated, they are hovering one downgrade away from junk because the ratings agencies, they hand out A's like rave bracelets at Coachella. If you just run the math, a 1% rise in global average funding costs, that torches roughly $2.5 trillion in global bond market value, totally vaporized. And even the government's official fake CPI inflation numbers, they continue to shred the real yields. So yes, in the world's most advanced economies, inflation minus bond yield is still negative. The light at the end of the tunnel for Bitcoin is the fact that the collateral that is backing the global credit stack is bleeding credibility in real time, and the genie cannot be put back in the bottle. The system leans on the assets that either inflate away or they reprice violently with every policy pivot. And here's the fun part. Listen to this. If just 5% of that $251 trillion debt pool demands harder collateral, which it will because it literally has to, that is $12.5 trillion, which, if you didn't know, that's about 6 times what the Bitcoin network is worth right now. So if you do the division, well, that equals north of $600,000 per Bitcoin. And that's before accounting for any reflexive upside, okay? And remember, that's just a conservative slice in the long run. I have seen grandmothers in Vegas put more than 5% of their net worth on some Karate Kid slot machine. If Aunt Gertrude will YOLO the family IRA on Shiba Inu because her hairdresser's Uber driver said so, do you really think that institutions are going to ignore collateral that they can actually audit in real time? And this is why my conviction in Bitcoin literally cannot be shaken, because the takeaway is brutal in its simplicity. Weak collateral has obviously bred extreme systemic fragility, and we can all feel that. Nobody trusts the institutions in our society anymore. And pristine collateral is going to invite capital like a magnet. And this is why I absolutely hate when people say that Bitcoin is digital gold, because that phrase undersells it. It is the only collateral in the world that is immune to dilution, political capture, and banking holidays. So when the next rate shock or inflation spike burns another few trillion off of the bond valuations, the migration into Bitcoin will be a stampede. The question is no longer will credit ever flow into Bitcoin. It is how much of this $251 trillion tidal wave will hit before you have secured your seat at the hard asset table. The people who are bearish on Bitcoin need to stop seeing Bitcoin as some investment fad. It is an engineering upgrade to the concept of collateral itself. The people with this volatility objection, let me clue you in, that is a price feature and not a credit flaw. Because here's a fun fact for you, the lender simply haircuts the loan to value. At today's 50% LTV norm, a $100 million BTC pledge yields $50 million in immediate credit. So if the USD denominated price of Bitcoin dives 25%, the collateral is still very oversecured. Contrast that with sovereign bonds. The price drops 10%. Suddenly you're scrambling for margin because the haircut was a paper-thin 2%. The overall valuation of the Bitcoin network in its entirety, as it grows, the volatility statistically continues to compress. So the loan to value ratchets up. The CME futures open interest in the BlackRock ETF spot. The CME futures open interest and the BlackRock spot ETF flows provide continuous two-sided liquidity to the asset, exactly what the repo desks crave. JP Morgan, for the love of God, the JP Morgan bank who just spent the last decade railing against Bitcoin, the chief executive officer, Jamie Dimon, calling it a scam consistently for years, they are now going to accept Bitcoin as collateral, exactly what I've been talking about for the past however many minutes. They're literally coming out to the public giving banker code saying, we plan to lend against this. So how do you not see the writing on the wall? If the broader market already understood what I know, Bitcoin would be $10 million a coin, but it's not right now. Therein lies the opportunity. The asymmetry of the information is the opportunity, and that is why I have been buying Bitcoin like crazy. Fun fact for you, last quarter, a provincial Chinese bank accepted aged Parmesan cheese wheels as loan collateral. Yes, cheese. If lactose-based credit lines are permissible, imagine the premium that Wall Street is going to slap on an asset with a global hash rate security and real-time audits instead of a sniff test in a dairy vault. If you're starting to lose me a little bit, let me bring it back to baseline, okay? The bottom line is that collateral is a hierarchy of trust. Fiat bonds continue to slide down the hierarchy over time, and Parmesan is apparently somewhere in the middle. Bitcoin is climbing to the top rung because it eliminates every single point of centralized failure. The lenders who recognize this first are going to write the new underwriting rules. The borrowers who pledge it early will lock in the cheapest capital, and the skeptics, well, they can just keep their cheese. And there's a man named Michael Saylor who understands everything that I'm talking about right now, and this guy is taking advantage. In fact, this guy has so much skin in the game that he's taking out billions of convertible debt just to buy more Bitcoin, and he's doing it at a blended 0.4% interest, which is cheaper than a student loan from the 1990s, for the love of God. So right now, investors are paying Strategy to accumulate Bitcoin on their behalf, and second, they keep every single coin unencumbered as of now. None is rehypothecated, none is pledged elsewhere. It is literally just sitting on the balance sheet publicly for everybody to see. There's so many haters lately because of the deleveraging of the equity because Saylor bought so much Bitcoin so quickly, but think of the larger macro picture here, okay? Zoom out. The equity market has rewarded this stunt. It's the best performing equity probably in the world over the last 5 years. Strategy went from $500 million in cash to a market cap of about $72 billion, which is handily above the Bitcoin that it owns. Wall Street is pricing in the company's ability to recycle the same blueprint at scale, a perpetual motion machine powered by the pristine collateral and very cheap credit. Are you starting to see the big picture here? And if you want to know if we're still early, recently a Fortune 500 CFO asked on an earnings call whether Bitcoin could be physically delivered for inspection, as though someone might roll a Trojan horse of sats into their loading dock. You could hear the auditor's soul leave his body, and Strategy's answer to this is very simple: custody keys, multi-sig, independent attestation from a Big Four audit. This is just the reality. Cheap, long-dated debt plus a finite hard asset beats fiat cash drag every single time. A lot of people have lost faith in Bitcoin treasury companies because of a multiple compression. At the end of the day, what was the original arbitrage opportunity here? It was the original speculative attack. Take out debt and a failing currency to buy Bitcoin, and that's not going anywhere. The lesson at large here is very brutal and it's very clear. If a mid-tier software firm can morph into a balance sheet titan by swapping dollars for sats, imagine what a AAA rated behemoth could do. Now, the window for front running this arbitrage is still open, but it is closing fast, and in my opinion, this is where a lot of money is going to be made. And the banks said it would never happen, yet here we are. They are proven wrong again in the face of orange Bitcoin glory. When the largest banks are deciding that the protocol is good enough to secure 8-figure loans, the debate is finished. The ledger has spoken. Just look 2, 3, 4, 5 years into the future where we'll see 1,000 companies like Strategy, each of them holding thousands upon thousands of Bitcoin, collectively freezing a quarter of the entire float. That liquidity crunch alone is going to force the lenders to get very creative. They will settle SAT-backed commercial paper, Bitcoin-secured revolvers, maybe even Lightning-settled corporate bonds. The collateral is going to migrate first, and then the denomination is going to follow, because the plumbing in the legacy system is getting ripped out and refitted in real time. The repo desks out there, they want assets that they can verify at block height, not wait for a transfer agent to fax a confirmation. Hedge funds demand lines that clear on Sunday, not T+2 with a holiday lag, and Bitcoin is the only collateral meeting those constraints without political baggage. And this is the end game, because once all of these rails are live, once the infrastructure is built and it is replaced into the legacy system, every single firm, every single institution that refuses to board will pay higher funding costs until the shareholders start to revolt. At this stage, the smart move to me is very obvious. Hold Bitcoin on your balance sheet, treat it like a callable capital line, post it when you need cheap leverage, pull it back when the spreads widen, and never worry about confiscation or dilution. And this is how the Bitcoin treasury companies are going to turn this volatile asset into a perpetual funding advantage, and why the old guard cannot stop them without banning arithmetic itself. Bitcoin as collateral is the ultimate turbocharging flywheel. The price of Bitcoin's gonna rise, the loan to value headroom is then going to expand, so the lenders unlock bigger credit lines, and then the borrowers just buy more Bitcoin, the price pops again, loop it on repeat until the bears scribble bullish hopium into their diaries. And remember, you can fold in the reflexivity as it relates to the higher BTC market cap compressing the volatility as well. So the loan to value ratio step upward from 50% to 70%, and that extra leverage would just fuel another buying cycle. And the ARK Invest models are giving a nice sanity sanity check to let me know that I'm not some crazy guy. Their conservative 2030 projection pins Bitcoin around $710,000 and their bullish path crosses 1.5 million. Yet they do not assume a wholesale migration of repo markets or sovereign collateral frameworks. So, in other words, the ARK bull case might be the on-ramp, not the peak. And if you want to have some fun with some moon math, just crank the knob a little bit. If half of the global credit decides it prefers scarcity to fiscal promises, that is $125 trillion chasing the same 21 million coins. And it'll be chasing it after another halving cycle, just to let you know. Even elementary school math shoves the price tag beyond $6 million per Bitcoin. At that level, every confirmation moves more economic energy than the GDP of a mid-sized nation. And this is what I mean by Bitcoin becoming the new monetary substrate. The flywheel is already creaking right now into motion. It is very obvious to anybody who's plugged into this thing. If you're watching this YouTube channel, well, just to tell you, you're very early. Just think every single additional corporate treasury stack with no incentive to ever sell their Bitcoin, every new spot ETF inflow, every single repo desk that will add Bitcoin to its collateral matrix. All of these things are going to tighten the circulating supply and amplify the price upward. And once this loop hits terminal speed, the only question will be whether your balance sheet is on the inside edge, catching the centrifugal force, or standing outside getting totally flattened by the monetary death spiral. So right now, to anybody paying attention, the spot ETFs are siphoning retirement capital like a Dyson on steroids. Remember, the most successful ETF launch of all time, not even close. Look at the results of IBIT versus the first ever gold ETFs, okay? It's ridiculous. The Wall Street desks right now are normalizing Bitcoin collateral. Imagine the CFOs start to slip 1% BTC buffers into their treasury policy handbooks. The regulatory sandboxes are going to morph into playpens for the grown-up capital, which is Bitcoin, okay? The funding costs are going to start to diverge. The firms with SAT reserves are going to borrow cheaper, and then the fiat-only dinosaurs are going to pay a penalty spread. And then I think 2030 to 2040 will be the sovereign catch-up, because remember, government bureaucracy is totally pathetic and they are late to the curve on everything. I think that the more forward-thinking central banks will admit the obvious and list Bitcoin alongside gold in their reserve reports. The key metrics to watch over this next global collateral inversion, well, it's pretty simple. Look at the Bitcoin share of global collateral. Right now, if it's at about 0%, target 5% in the next 3 to 5 years. The loan to value haircuts, if they're 50% today, look at the 70% once the market cap hits $10 trillion. And just continue to look at the corporate Bitcoin treasury penetration from the single digits to even the double digits in the 2030s. If any two of these metrics start to accelerate simultaneously, the price curves are going to look vertical on even a log scale. Just look at what the world is accepting as collateral for loans right now. Do not tell me that a SHA-256 secured asset is too risky. If you think that's the case, you are literally just an idiot. This is not financial advice. This is financial entertainment, but this is your action plan right now if you're not sub 80 IQ. Accumulate the hard collateral now before the flywheel hits terminal velocity. Stress test your leverage. If you're not a degenerate, you're still going to be fine. And number 3, for the love of God, take up the orange torch and start to educate everybody that you know. If the board of the company that you sit on doesn't understand this, well, the cost of ignorance is soon going to be denominated in Satoshis, and the bill is going to start to compound daily. So to all of the bears out there, I just got to tell you this. When the historians chronicled this era, they are very clearly going to notice two camps. Those who front ran the collateral migration and those who tweeted jokes about tulips while their purchasing power withered. So choose wisely. Scarcity never negotiates. My name is Adam Livingston. I am the Bitcoin Wizard. If you like this content, please like this video, subscribe to the channel, and let me know what you think I should comment on next. Leave a comment too, because it helps the algorithm naturally spread the orange gospel to those who need it the most. Have a terrific day. Do not party too hard. Class dismissed. Once again, a special thanks to Horizon for sponsoring this video. Most people don't realize this, but on average, 60% of American homeowners' net worth is locked up in their primary residence. And with home prices more inflated than ever, Americans now sit on a combined $35 trillion in home equity. Now there's a way to unlock that trapped capital and put it to work in Bitcoin. Horizon helps homeowners unlock a portion of their home equity to buy Bitcoin. It is not a loan, so there are no new monthly payments. You keep living in your home as usual, and then later when you sell, refinance, or choose to settle early, Horizon's provider takes an agreed share of your home's future value. That is the trade. Unlock cash now to stack Bitcoin by selling a slice of your home's future value while you continue living in it. What makes Horizon stand out is that there are no term limits and you keep 100% of the Bitcoin upside. The Bitcoin is fully yours to custody however you want, wherever you want, with no risk of forced liquidation. If you've been sitting on a pile of home equity and are eager to invest in Bitcoin, this may be the product for you. Visit joinhorizon.com to see if you qualify and get started. Their team of experts will work with you one-on-one from start to finish. Transform your dormant home equity into Bitcoin today with Horizon.